Strategy number one, I'm going to go through a couple of simple ones, and then I'm going to go through a couple of complicated ones. First thing, don't be afraid of bonds. Buy bonds. Bonds are good. Bonds have security. Yeah.
Aren't they fairly low yielding?
Yeah. Well, I mean, that depends on perspective. Remember, everything's about perspective. It's better than losing money, right? So let me run through how bonds work, because a lot of people don't understand the bond market. But if you take a look at the bond market, here's what happens. Here's what happens with the stock market. We talked a little bit about the stock market. Stocks grow like this, right? Now, bonds don't grow based on psychology. They don't grow based on valuation. What bonds do is bonds grow based on fundamentals of quantity and price. Just like the economy, there's a demand for bonds, and then there's a supply of bonds. And so what happens is there's what's called bond price equilibrium, and that's what sets the price of bonds. Now, there's a lot of different types of bonds, and one of the questions you might ask when if we sit down is, what kind of bonds do I buy? Right now, there's a guy, he won a Nobel Prize for this. He says, you know what, if you take a look at your investments, one of the biggest mistakes all investors and all advisors make is they look at the return on their investments. I'm going to suggest that you frame it by looking at the standard deviation or the risk in your portfolio first, and then look at your portfolio, because the first thing you want to do is protect your capital. And so if you look at standard deviation, sorry, that's a little sigma, but it stands for standard deviation, and return, basically this is your return spectrum, and it is global standard. All countries in the world say there are 6 different types of risk and return you can take. And they have what's called a risk-free rate, and the risk-free rate right now is, in Canada, it's about 3.5%, it's GICs or treasury bills. So these are guaranteed products. Zero standard deviation. Then there's something called conservative, then there's something called moderate conservative, then there's something called moderate, and then there's moderate aggressive. The guy wins a Nobel Prize for that. Basically, his theory is that you take more risk, you get higher return. Now, it was a little bit more complicated. He talked about utilities and indifference theories and stuff like that. But there's different types of bonds. So yes, to your question, bonds are a little bit low yielding. It's like right now, if you look at the risk-free rate being 3.5%, that's called your yield. You'll get a government bond with about a 4.5% yield. You can get corporate bonds with a 5.5% yield. Now, of course, corporate bonds have a little bit more risk. Yes, that's how they give you a little bit higher return. But that's just the yield. Now, we talked about the stock market and the bond market and how they work, but let's assume for a second that the stock market gets hit 40%. What happens with that money? What do people do? They sell. The money's got to go somewhere. This movement goes here. This is known as a flight to quality. The money gets out of the stock market and moves bonds. If the demand for bonds increases or shifts to the right, that causes a movement along the supply curve in the price of bonds, not affecting the yield, but the price of bonds. So to answer your question, yes, the yield might be 4.5% in government bonds, 5.5% in corporate bonds, but what if there is a flight to quality, which of course there is right now, that causes prices to increase by, let's say, 1%. That gives you capital appreciation in your bond as well. Now, we talked a little bit about fiscal policy and monetary policy. I don't know if you guys remember, because that was a long time ago. But we talked about which way is the economy going. Well, we're heading towards a recession. The government has to do what with monetary policy with regards to interest rates? Go down. Thank you, sir. If interest rates go down, which way do bonds go? Up. They're inversely correlated. So if interest rates go down, bond prices go up. So you get another 1% yield in your bonds. You can get 6-7% in bonds safely. I'm not saying put all your money in bonds. I'm saying don't ignore bonds. What? Huh? Oh, you can't. Sorry. Yeah, okay, thanks. You're holding up a red card. I'm supposed to know what you're saying right now, eh? Okay, strategy 2. Yes, sir.
I don't want to interrupt you.
No, no.
But in regards to the bonds, are you talking about bonds in the sense of playing the market with the bonds or buying a bond that you want to mature at a certain time, 2012, 14, and hang on?
No, not buying it forever. You look at your time frame and, yeah, very good point. There's different types of bonds. You can buy them to maturity or you can buy them and trade them. The problem when people buy bonds is they look at what's called the coupon rate. You want to look at your yield to maturity. I would suggest the first thing you do is you evaluate yourself, you look at your time horizon, you look at your risk tolerance, you create what's called asset allocation strategy first. Then what you do is you define how much of your portfolio is going to be in bonds. I mean, there's 4 different asset classes. And so I wouldn't be holding them to maturity. No, not at all. Good question. Okay. Number 2, here's one of the biggest problems. We don't think long term anymore. Everybody now, the average holding period for a US stock used to be 8 years in the 60s. It is 8 months today. Short-term proliferation is thinking. Now here's how it affects us, and here's why it causes us to stop making bad decisions. Because there are no patterns mentally in this graph. And when we see no patterns, we stop making decisions because we do not have the ability to make a decision, because what we're looking for is states when we invest. We don't realize that everybody thinks they want money for a car or for something like that. No, we need states. And there are different states or values that we're trying to appeal within ourselves. One of the states that we're looking for is the removal of anxiety. These short-term graphs enhance our anxiety. There's no pattern, there's no trend between these lines. As a matter of fact, there's too much down for my comfort. So I'm better off sitting on the sideline doing nothing, and that's what kills us. Doing nothing kills us. So there's a lot of volatility. These are the monthly percent changes for the Toronto Stock Exchange. That's all the stocks in Canada. If we were to look at this on a 10-year frame, and when I say long-term, I'm talking 10 years, a pattern emerges. There is no negatives. Now, that doesn't mean that it can't be negative in the future. That just means based on the past 40, I can go back to the 60s and 50s, based on the past 50 years, there is a 0% chance of losing money in the stock market. Does not mean that it can't happen in the future. But that is a pattern. The problem is we don't have the ability to think 10 years in advance because we aren't trained to think holistically. But if we can step out in the markets and we can frame things properly and we can say, will people be driving cars in 10 years? Absolutely. And if they will, then I need to own oil and gas companies. Do I think people are going to get sick in 10 years? Absolutely. So then I need to own healthcare companies. Are people going to be banking in 10 years? Maybe not. Absolutely. Then we got to own banks. Let's just take a look at the last 5 decades. In the 1960s, what happened was Berlin Wall was eliminated. There was a Cuban Missile Crisis. I don't know if any of you read about this, but the markets dropped about 30% during that time. JFK was assassinated. Markets dropped 30% that year. Vietnam, and still that decade, the average return in the stock market was 10%. Well, might have been an anomaly. Let's take a look at the 70s. In the 70s, 250,000 people dropped in Vietnam. Just died in a war. Nixon was impeached with Watergate. The interest rates started to rise. The market return during that decade was 10%. The average return on the market was 10%. In the 80s, I don't know if anybody remembers, anybody buy a house? How many people here bought a house in the 80s? Yeah. You remember the interest rates you were paying for that house? Remember Black Monday when the markets dropped 30%? The worst deficit in history, 300 bank failures. 300 bank failures. What did the markets average that decade? Another 12%. And it continues. I mean, we know what happened in the 90s with Y2K and the Gulf War and Oklahoma and the 91 recession. The markets averaged 10%, and so on. So, again, we have to frame how we invest through our company. So I'm going to go through some tax and investment strategies for business that are a little bit lesser known. The first thing we have to understand is that if we are incorporated, our business tax rate is 16.5% in Alberta.
Isn't it 22%?
No, it's 16. They just reduced the rates. So if you have, I know a lot of people aren't sure about the tax rates, but here's how you calculate it. First of all, as a business owner, we own what's called a Canadian Controlled Private Corporation. So whether I'm a dentist or a doctor or a pharmacist, I'm incorporated and I own that corporation. I own what's called the common shares of that corporation. So this is my Prof Corp or my company, and I own the common shares of that company. Kind of like you did, like you said, when you own Bank of Montreal, but there are tax breaks because Bank of Montreal is a public company and you own your own Canadian company. And so the tax rate isn't 22%, it's a mistake. What happens is we have a federal tax rate at 38%. Then you have something called a 10% abatement, and that abatement is so the provinces can levy their own taxes. So this is a federal rate. So that brings your corporation down to 28%, and then you got a surtax of 1.1%, so that brings your net federal tax to 29.1%. Then you get something called a small business deduction, and that is a deduction based on a certain amount of income that you get for owning your company based on a certain type of income called active business income. And so that brings your corporate tax rate down to 13.1%. What's Alberta's tax rate?